Howdy, Jacob here. Happy Valentine's Day, everybody. So today we're looking at Amplify Energy. We see that they are in the oil, gas, and consumable fuels industry. $233 million market cap on $347 million enterprise value. So a little bit of net debt here. Very small company. Let's look at this insider ownership. Just 1% it says. Interesting. So the growth the last 2 years has been pretty substantial, similar to other oil, gas, consumable companies. Looks like they develop, exploit oil and natural gas. Yep, sounds about right. Their return on invested capital is 32%, but outside of last year, they've only had like 2 positive years of growth, or 2 positive years of earnings. So that's interesting. So the balance sheet, 190 million long-term debt with 0 liquid assets, 0 cash equivalents. So let's see what that is in relation to cash flow. This might be the first company we looked at that I'm not even sure is an actual good company. All right, so they have been paying down their debt every year since 2018. So you got to think that that's a positive. So they know that they have more debt than they probably should. On a 5-year average basis, we're probably looking at 30 million. So that debt is roughly 7 times their 5-year average free cash flow. They only have debt in their what they use of free cash flow. So that's interesting. There's just not a lot of data here. There's not a lot of history here to where I can really decipher, are they going to be reinvesting a lot of their money? Are they going to be issuing it out through a dividend? And I mean, the debt repurchase is great, but it gets to a point where then you have no debt. Then what do you do? And I don't know what they'll do. They have a tiny bit of history buying back shares, but their shares have increased quite a bit. 2019, 2020. What's that? Okay, probably some crazy assurance of diluted shares. So I think I'm ready to start making some assumptions here. This is a tough company, much tougher than the previous 8 of this screen that we looked at, since it's just very volatile, very small company, and the use of cash flow is interesting. I would say, they've grown so much in the last 2 years and not from acquisitions, so I'll probably throw 0 and 10. I usually like to do 0% growth and 10p price free cash flow, given that if I think it's going to be essentially no growth business, or maybe they'll decline in the recent years and then maybe be able to have some growth later on. But at the end of 7 years, it'll be essentially a very little to no growth business. And then you have margins all over the place. I guess I like free cash flows higher on average, but I'll probably just do an average here. Let's do 8, 10. Let's do 1%, 2% share change, and we get to a price that needs to fall 61% before you get the return that I'm looking for. I don't even know if I would add this to a company I'd want to hold for a while, just because. There's always a price that I would buy stocks at, or buy any company at, if it's a positive producing cash flow company. But for me, I definitely have to do more research on this, because I just don't understand it at the moment. But I think that their high ROIC is really just a one-time thing. Could it go on? Absolutely. But I just see it being a one-time thing where revenues jump so much, earnings have jumped so much, and cash flows jump so much compared to history. But they do have a 0.7 balance sheet, but a lot of it is property and plant, so not even 1-for-1 likely, if they were to liquidate or anything. So Interesting. So I think I hope everyone had enjoyed the video. That's the rest of the day. Thank you.